So increasing life expectancy is also a trend that financial consultants need to take very good care of. I think that it's quite common that, like if you try to open a concept by saying that, actually the life expectancy in Singapore has increased quite a lot, and then you try to link it up to retirement, it's usually not a very successful concept in my experience. I've had attended various agency trainings where not just my one, but like other people's one, where they tried to use this as a concept, and the reception usually wasn't very good. And so the reason for that is because retirement as a concept is, firstly, it's relatively new. And so because of CPF Life, most people would assume to a certain degree that you would want to try to plan it out to like 99 regardless. So the idea that you have increasing life expectancy till about 82, 85 years old is actually kind of redundant to them. And so most people wouldn't think that they need it for more or less retirement. The only times where they do consider is because they are like usually low on budget, right? So what happens is that they want to have more between 65 and 75 compared to very little between 65 and 99. Right? Because you only can spread out so much budget across that particular duration of time. Yeah. So what are the clearer or stronger opportunities for understanding that we have increasing life expectancy, right? Well, firstly, we have to understand that the quality of life in Singapore is so high that we are competing with Japan for the highest life expectancy in the world. Yeah. So literally, if you grow up in this country, there's a very decent chance that you'll live longer than anyone else on the planet, right? And that's really something, because that really speaks to our general quality of life. Like we look after, or we have the capacity, I would say, to look after ourselves very well here in terms of what we're provided with, shelter, food, water, etc. Like we don't lack clean water, for example. And so obviously things like that help to increase our life expectancy quite a lot. And so as a result, what tends to happen is that one of the clearest strengths, or the slightly more obvious strengths in terms of understanding this, is that the idea that we should have term insurance till 65. This is one of the concepts that I use for opening cases sometimes in relation to trying to get larger premiums, right? The idea that you should have insurance until 65 is usually quite a poor idea. And the reason for that is because realistically you are not, or you're much more likely to live past 65. 65, of course, some people would argue that the reason why you have the insurance till 65 is because you're not likely to work till 65. But that's a pretty interesting downtrend in some sense, right? Because about 20-ish years ago, 20 less than 30 years ago, basically your average lifespan in Singapore was about 70 years old, compared to now, which is at about 82 or 85. And people worked till they were about 55, 56, right? And so you can see that in about 20, 30 short years, what has happened is that the retirement age has jumped up quite significantly, and the life expectancy has jumped up quite significantly as well, right? And so by the time it hits your generation, which means that for your clients which are now 20 or 30 years old or 40 years old, there's a pretty decent chance that you could double that, or your retirement age could be easily like 70 something. Your need for life insurance, like your basic term insurance where you stop working, would be 70 something or even 80 something as well, and so this is easy to identify and isolate as a trend. Some of the weaknesses of this is that basically I would say that a lot of people would still be relatively cynical about the fact that we have a high life expectancy. Most people tend to overestimate themselves when they die. It means that, or when they look like they could die, or when they think when they will die. Like if you ask people like when they think that they will die, most of them will under project under 85. Many people don't think that they're going to live till 99, for example, right? And so even the thought of living till 85 is not very common for most people, and so they may plan their finances accordingly, which is usually quite a poor course of action, right? And the reason why I point this out is because while it is your job to change their minds, it can be very challenging, because you need to be able to substantiate why this kind of line of thinking is very foolish, and that also puts you in conflict with the client immediately in terms of how it should be planned, right? Because you could acquiesce to what they want, and set them up with like a term insurance, so maybe like 55 or 60 or something, but realistically they should have one for like a lot longer. And then if you try to suggest that, then you'll come across as someone who looks very greedy. For some of the clearer opportunities, one of the more dominant opportunities that we're seeing currently that is less explored, right? So when I say strengths versus opportunities, strengths are what people are currently using now, I would say, and then opportunities are, I would say, what will grow as an opportunity in relation to this trend, right? Which means that this is something that not a lot of people will identify, yet it will continue to become a larger and larger opportunity compared to an existing strength that may somewhat become mainstream over time and die out, or maybe just like everybody's doing it, so it's not that much of a strength, but it's a general strength, right? Basically, risk-adjusted mortality has not been scaling as well as life expectancy. So what is risk-adjusted mortality? Basically is in relation to your health, which means that how long do you stay healthy for during the period of which you are alive, right? And so here are some interesting rough idea statistics for you, roughly. I don't really have sources on me right now, but basically in the 1990s, what would happen is that you had risk-adjusted mortality, which is that your health remained relatively good, like you can walk up and down stairs, for example, or maybe you hobble a bit and it's a bit of a struggle, but you still have basic mobility, you weren't experiencing disability, right? So you had that for till you're about like 65, 66 or so, but your life expectancy was until about 70, right? Which means that you were probably only in poor health for about 3 or 4 years. Yeah, but presently what has happened is that your risk-adjusted mortality currently is at an average age of about 72, 73, while your average life expectancy is about 82 to 85, right? And so what that means is that you're likely to be in poor health for 4 to 13 years of your life, compared to a period where, and why am I saying not 4 to 13 years? It's much longer than that. It's 9 to 13 years, right? 9 to 13 years of your life compared to a period where it used to be somewhat unhealthy for 3 to 4 years, right? And that's a long time to go unhealthily, in the sense that you're not able to walk and feed yourself and all that stuff. And so that is partly why this particular idea has been substantiated with the provision of the government making CareShield Life mandatory. But it's kind of important that you are able to use this as an opening concept to sell much larger disability insurance as well as critical illness insurance. For a lot of the wealthier people, I think that they'll be very interested in having DPD for life. Yeah, so you can sell large whole life insurance plans, which is actually what I see some of the larger producers in this space actually do. So they sell like big single premium whole life plans with TPD benefits. Yeah, and so basically the reason why they can do that is because they are able to take advantage of their knowledge of this particular trend and turn it into a concept where people can understand inherently that this is a very serious thing that could happen to them, especially because high net worth people and mass affluent people tend to have some degree of interest in their own personal succession, right? Which means that even if they're not very interested in what we call legacy planning, means that we are not that interested in passing on huge amounts of money to our dependents, right? But we don't really want a situation where our dependents are forced to give up their own money or what money we were going to pass down to them, however unplanned, to go and take care of us, right? Or we don't want to burn so much of our own resources that we could have given to someone else, right? Yeah, so the behavior to kind of notice here in this situation is that a lot of people can be very averse to generational wealth, which means that they really don't want to be passing on like too much money to their children, for example, or to their dependents of any kind. Usually when you ask them, they tend to be pretty averse to this general idea of generational wealth. But what happens is that if it turns out that they are in a situation where they need to spend a lot of that money on their own poor health, right, then they would be pretty upset about it, rather that they had been able to pass on more money to their children instead. You know, and so that's a concept that I found has been very effective for the mass affluent and high net worth. It's a very, very clear opportunity, and that this opportunity will only grow quite significantly over time.